Hey, so you just sold your house, you made $2 million, and guess what? The accountant calls you, and you tell him you're excited and jumping for joy. But then your accountant tells you you're going to owe $600,000. Now you're not so happy. That $2 million of cash that you just got, well, now knock it down to $1,400,000. And that check you have to write to the IRS and the Franchise Tax Board, not feeling so hot right now. And now all the money you made on your Los Angeles home going down the drain to the IRS and the Franchise Tax Board. But what if I told you that there are completely legal ways to defer your taxes, reduce your taxes, or completely eliminate your capital gains taxes from the sale of your property? That's what this video is about. Stick around, let's go to work. Hey guys, it's Kevin DaSilva here with the Living Los Angeles channel. And my mission is to help you grow your wealth through your living situation. Sometimes it's by making better purchases. Other times it's by getting the most from the sale of your house. And along the way, it's helping you make smart renovations to your home so that you pocket more money. Well, today's episode is all about how to keep more of that money in your pocket once you sell that house.
How to add sweetness to your life? When you want a snack or prepare for the holiday parties, don't forget this cookie for you and your family.
And so today we're going to talk about the 7 strategies to reduce your tax liability, defer your taxes, or completely eliminate them. So the first one we're going to talk about is the most common one. Now, this is your principal residence tax exemption. What is a principal residence tax exemption? Well, if you have owned a property for 2 years and have lived in it for 2 out of the last 5 years, then you are eligible for either $250,000 or a $500,000 tax exemption on your capital gains. The example here is you bought it for $1 million. Today it is worth $1.5 million. You sell the property, assuming there's no closing costs, stuff like that. You have $500,000 of gains and you're married. You and your wife have both lived there for 2 years, and you can sell the property and you will likely not pay any taxes. Now, that's right, you heard me. $500,000 tax exemption if you're married. For single people, it is $250,000. Now, it's not single as in your romantic life. It's single as in the way you file your taxes. Now, one of the drawbacks of this strategy is, let's say you bought your house for $1 million 40 years ago, but now today it's worth $3 million. You only still get to write off that $250,000. So what happens to the rest of it? Well, it gets taxed at ordinary income and capital gains limits. Why do I say income? Well, to the IRS, they look at it as capital gains, long-term capital gains. But to the Franchise Tax Board, they don't have a capital gains rule. So it actually does report as income. It just has different treatments compared to the kind of income that you get from your job. And so for the rest of this video, we're actually going to talk about what do you do if you're in excess of that, or you don't live there and you've been renting the property out this entire time. So what do you do with the rest of the money? Well, you can do a 1031 exchange. Most people have actually heard of it. Now, some caveats about this. Think about a 1031 exchange as hitting the pause button on your tax bill. As long as you're selling one investment property, you can roll it into another investment property. But that's one of the caveats. You have to have rented the property out and are no longer claiming it as a primary residence. A few other caveats are you have to trade into another like-kind property of equal or greater value. Now, if you don't, your cost basis carries over to the next property, but your gains in which you did not reinvest get taxed. But also be careful, because there is a depreciation recapture that can exist, and this recapture is not small. In fact, they can reclaim 25 to 35% of your depreciated value and hit you with that bill after you sell the property. Then you have some more nuances, like you have 45 days from the sale of your property to identify 3 other replacement properties. And then you have 180 days from the sale of your property to close on one of the properties you identified. And if you don't meet either of those 2 time restrictions, you end up having to pay the taxes. This is where you need a professional team, because any mistake can cost you huge tax dollars. And you need to avoid taking any boot. Now, boot is essentially you can't take any cash out of the deal or lower the mortgage amount. In either of those 2 events, you can be taxed. We can even connect you with our preferred vendors to help you do reverse exchanges or improvement exchanges. But that's an entire topic for another video. Now you see things are getting a little more advanced, but they'll get a little easier here in just a second. Now, what do you do when you want to sell a property, but you don't really want to go buy another property? One opportunity available to you is to provide seller financing, or what is called an installment sale. This is where instead of a buyer getting a loan from a bank, you're actually being the lender for them. And then they pay you in installments. These can be monthly, quarterly, annually, whatever you guys agree to. One of the great parts about it is you actually get to make money on it because you're going to be charging interest. Now, those interest payments do get taxed at ordinary income, but you reduce your tax liability because you only pay capital gains taxes on the principal balances as they get paid back. So instead of being at the highest level of tax brackets for everything, you could potentially drop yourself down to the lowest level, saving you over 10% just in taxes. But there's a huge warning to this. The IRS has a trap. It's called the depreciation recapture. Just like a 1031 exchange, the installment sale does not defer this tax. Two, the IRS requires you to pay all of your depreciation recapture in 1 year, regardless of how much down payment money you received. This can be a cash flow nightmare if you haven't prepared for it. All right, here are 3 strategies that are so specialized they need their own names. This is what the most sophisticated clients are using to avoid or defer paying taxes. First and foremost, the Deferred Sales Trust, otherwise known as an installment sale trust. This is one of the best alternatives to a 1031 exchange. You transfer your property to the trust, and the trust sells the property to the buyer. The trust then reinvests the profits, deferring your capital gains. Some of the benefits of this strategy are that you get to recapture your cost basis at some point, unlike a 1031 exchange where your cost basis keeps exchanging to the next property. Now, the main benefit here is you don't have to go buy another property. You can, but you don't need to adhere to 45 days to find it. You don't need 180 days to close it. One of the main differences here, though, your trust, if you do buy another property, owns that property as well. Your income kicks into the trust and is tax deferred, but you can never move into that property. Yeah, that's right. With a 1031 exchange, you can actually buy a property, rent it out for at least 2 years, and then move into it. Later on down the road, if you were to sell it, having lived there for 2 out of the last 5 years, and at least owning it for 2 years, you can sell it and use your primary residence tax exemption, which was the first thing we talked about. But with an installment sale trust, you aren't limited to other properties though. You can actually go buy stocks, you can reinvest it, and however you really want. You can leave it there as cash and just pull on it in installments, paying taxes on it as it comes out. Once again, just like the installment sale where you did a seller financing, part of it will come out as principal and the other part of it will come out as capital gains. And anything that you made money on in the short term will come out as income. The next savvy tool is a charitable remainder trust. Similar to the installment sale trust, the trust takes possession of the house, then sells it to the buyer. The proceeds from the sale then kick into the trust, and you can avoid paying taxes. This is for when you're feeling philanthropic, but you still want to make some income along the way. In this charitable remainder trust, it is an irrevocable trust, which means you can't undo it, unlike an installment sale trust where you can, assuming you're going to pay all the tax liabilities. But this charitable remainder trust does sell 100% tax-free. The trust then invests the proceeds, paying you along the way, and when you pass, the remainder goes to charity, and you pick any charity you want. It's one way to avoid paying taxes, but still make the world a better place. The benefit of this type of trust is you get a massive immediate tax deduction. You avoid the gains tax, and you get an income stream out of it. But the downfall? You probably guessed it, it's irrevocable. You can't undo it, which means once you've done it, you're stuck. The wealth replacement strategy is often used here when you use your income to buy life insurance for your heirs. And last on these savvy techniques is the opportunity zone. You can sell any asset, stock, art, real estate, cars, collectibles, you name it. And you can roll that into an opportunity zone fund. The main benefit here is if you hold that investment for all 10 years, all that new growth and all that income in the fund is 100% tax-free at the federal level. But did you hear that? The federal level. California does not recognize this. So any gains from the sale are still taxable at the state level, which could be a huge risk for all of my Los Angeles clients. The other risk is that you have to invest in opportunity zones. And these are usually areas that are underdeveloped and less established with the kind of homes you're going to be. One way to reduce your tax liabilities is to make home improvements. It's probably the simplest of all the tactics. This is called adjusting your cost basis. That kitchen remodel you did in 2018, that roof you put on in 2020, the garage you turned into an ADU in 2022, every little improvement you've made to your house can add up and affect your cost basis. Now, it gets a little nuanced here because you can't write off repairs unless you're making an upgrade to the property. For instance, adding retrofit windows is a huge upgrade and a value add to the home. I know when I did it to my house, I spent almost $10,000. The key aspect here is you have to keep your receipts. Every check you wrote to a contractor, every invoice you have marked paid, download that account statement to show that you paid it. Because when you go to sell your house, you're going to need that. And by increasing your cost basis, you're reducing your taxable gains. But this is one of the biggest things my clients forget to track along the way. When you're in the middle of making all these remodels, you aren't thinking about selling your house. And I almost forgot to mention one last one, tax loss harvesting. It's where you intentionally sell assets that you are experiencing a loss with to offset the gains you're going to realize from other assets that are experiencing a profit. But you could really do that with any of your assets. It's not particular to just real estate. So there you have it. From your principal residence tax exemption to 1031 exchange, an installment sale trust, doing an installment sale, also known as seller financing, to a charitable remainder trust, and improving your cost basis. As you can see, these are just the main ways you can either defer, reduce, or eliminate your tax liabilities. If you want a complete list, go ahead and comment below and we'll get that over to you. We can even connect you with the right professionals who can help you with each and every one of these. Always check with your accountant, always check with your attorney, and always check with your family. This video is for educational purposes only. It is not to be tax advice or legal advice in any way. We are sharing things with you so that you can understand what's out there and available. But ultimately, you should check with your accountant and your attorney to see what's viable for your situation and if it can work for you. On future videos, we're going to do a deeper dive into each of these because they are very nuanced and I didn't want to bore you too much with this one video. But if you want to get started on one of these because you don't want to pay the taxes, go ahead and comment below so that we can connect and see what is the best path for you. Once again, it's Kevin DaSilva here with the Living in Los Angeles channel. Until next time, hit the subscribe button, turn on notifications so you can be the first one to see this before we give it in our newsletter.